Friday, we get our December jobs report. We want to break down the state of the labor market, what to expect. We're appearing in our panel. Cory Stahle is with us, economist at Indeed, and Keith Buchanan, portfolio manager at JOLTS Investments. Thank you both for being with us. So, Cory, I'll start with you. Some of your thoughts on what we could see for Friday's jobs report.
Yeah, so I mean, as we look at tomorrow's jobs report, obviously there's no surprise that we've seen continually declining numbers over the past couple of years. And so we've seen, pretty moderate. I think as we look towards tomorrow, chances are we continue to see some of that moderate type of numbers, right? Kind of we want to see something kind of a little bit warm, we kind of in the 150, 160 range is kind of what we're expecting. So I think looking for that, I think also the other thing that's going to be really interesting to look at is on the household side of the survey. We've seen unemployment kind of gradually moving up throughout the year, which is never the most encouraging sign. We've seen a lot of that coming from people coming back into the labor market, but we've also seen recently some of the permanent layoffs and some of the more concerning side of unemployment ticking up. So I think that's really what we're looking for, is looking for obviously the headline number, but then also watching what's going on in the household survey. Does unemployment continue to rise kind of as we've seen throughout the year?
Yeah, understood. I mean, the prior number was 227, 164 is the estimate, I believe, for tomorrow. And we've still had, while there's been some unevenness, and even 1 month that had, dismal jobs numbers. What do you think, Keith?
Well, thank you for having me, Nicole. We've been doing a lot of research on kind of where we are in this moment. And it feels like a moment is building for, either a break one way or the other from a risk market standpoint. And the context with that was set up really by the FOMC yesterday. They talked about the risks of inflation being higher and the road to 2% perhaps being longer. This jobs report tomorrow really, gets us along the way in that story and helping us understand just how gradually the labor market is loosening. And if it proves to be tighter than the market expects, you mentioned 164-ish to 153 kind of being middle of consensus. If we're tighter than that and wage gains show a little more pressure than that, rates right now are at 4.6, 4.7, pushing north of that moment will actually put pressure, we think, on risk markets as it has in the past over the past couple of years. So we're a real precipice of a divergence of paths, if you will, on risk markets. And a lot of it plays into where inflation goes. And we'll see a lot more of how tight our economy is from the labor market in the report tomorrow.
I love your comments. Steady as she goes, jobs report. That's what the bond market wants. They want to show the inflationary conditions are continuing to moderate. And so that becomes, this is the mandate of the Fed here, Cory. We think about inflation and the labor market. And there was a time they were worried about inflation. Then they were quickly focused on the labor market and then off that once again. So are we concerned that the Fed is going to be overly concerned here about the labor market once again, Cory? Do we have to worry or not necessarily?
Yeah, I mean, that's a great question, right? And that's at the front of everybody's mind. I think as we look at a lot of the numbers, so yes, things have clearly cooled, they've clearly moderated in the last couple of years. But I think we're still in a pretty good place. We got JOLTS numbers this week. We're looking, job openings are still 16% above where they were before the pandemic. We're seeing a similar thing on Indeed and our platform and seeing that job postings are still well above where they were before the pandemic. So those are encouraging things. A lot of the concern around the labor market this year has come from things like the gradually rising unemployment rate. And we've also seen in the JOLTS report this week and really in the last few months, we've seen that hiring and quits have been much lower. They're actually near decade lows. We're seeing hiring and quits much lower, much less turnover, a much less dynamic labor market. And that's obviously a cause for concern. But what I think is important to note is in the report we got this week for JOLTS and what we've seen in the last few months is we started to see some signs of some potential stabilization there. Obviously these things go up and down from month to month, a little bit volatile because of the surveys. But when we start to look at the moving averages, we're seeing that there are some signs the labor market might be kind of steady. And I think that really is lending to, the Fed's perspective on, there's a little more room still to navigate in the labor market right now. But obviously they're going to watch that closely as we head into 2025 and future interest rate decisions.
Yeah, and Keith, how do you set up a portfolio now, knowing that you are more likely to get 2 cuts instead of 4 cuts from the Fed, the jobs picture, assuming it comes in pretty much in line? How are you setting up portfolios now? Are you sort of preparing for volatility, inflation, rates coming down?
Great question. We've actually been pulling back from U.S. growth, which is a preferred habitat for us for several years now, over the course of the year, just because of the conversation we're having now. As this last mile to 2% seems to be more difficult, we'll see more again in tomorrow's report. But it's taken longer than the market expected a year and a half ago. And because of that, rates remaining higher puts pressure on longer duration assets. U.S. growth, particularly large cap growth that's performed extraordinarily well, was a really good source of funds for us over the course of the year. And we're more balanced with growth and value going forward into 2025. So we've been pulling back our risks as we feel like higher rates on the longer end could put pressure on high duration assets, and stocks being one of those, and other in the spectrum on U.S. growth. So we've been pulling back on our risk over the course of the year, and we plan to be more balanced going forward in 2025.
Right, understood. I mean, if you're pulling back on U.S. growth, what are you looking to instead?
We've been getting more balanced as far as owning more value per the dollar of growth that we own.
Value.
Also, on the fixed income side, we've been purchasing some on the short end as well to make sure that we have some ammunition in the case that things kind of go awry more quickly than we've determined,
Yeah.
and we can get back into more opportunistic
Okay.
positions at that point.
Right. And Cory, within the report tomorrow, I always like to look at the labor force participation rate. I like to look at the wages. There are so many things within the report other than just, how many non-farm payroll jobs were created. What are you going to be watching for specifically that could be a real determining factor?
Yeah, I mean, I think one of the things I'm really interested to see is the broad nature of the job gains, right? Do we see job gains start to broaden? Over the last year or so, we've seen that most of the job gains have really been concentrated in 3 industries. We've seen government, we've seen leisure and hospitality, and of course, healthcare have added about 75% of the jobs. Obviously, for the long-term health of the economy, we want to see that start to broaden out, start to reach into other industries. But as you pointed out, we look at the labor force participation rate. That's something that I'm going to be watching really closely, because that's something that coming out of the pandemic rose gradually, but we've started to see the top line labor force participation start to flatline in the last year and a half. We've seen prime age participation continue to tick up, but in the last couple reports, it's actually started to move down, which is a really concerning sign for the labor market if we start to see fewer people participating and it becomes harder and harder for employers to find workers. So very important things to watch. Obviously, as you mentioned, wage growth will be important as well. And we'll get some ECI numbers at the end of the month as well that'll give us more insight as to where we're at with wages currently as well.
Yeah, look, you have a lot of those baby boomers who have retired or stepped away from the workforce. The other factor, just quick thought here on this one, Cory, is about AI and how AI may change the job landscape.
Yeah, I love that. Yeah, indeed, we sit in this really unique position where we have all of these different job postings, all of this data, and a lot of insight as to what AI might do on the labor market. Right now, we're seeing obviously there's a lot of investment, a lot of spending going into AI. But so far on our platform, we're not seeing a lot of job postings in terms of the overall number. It's only about 2 jobs in every 1,000 that are asking for generative AI type of skills. It's grown exponentially in the last year or so. And so as we look towards 2025, I anticipate we'll continue to see that trend up, but we're still at a point where it's not really having a major impact on the labor market yet. But obviously with the investments and all the promises of this productivity enhancing technology, I think we're going to start really seeing some movement in that direction in the coming year.
Right, understood. Thank you both so much. Cory Stahle, and also economist over at Indeed, Cory, and Keith Buchanan, portfolio manager at Globalt Investments. Thank you, Cory and Keith.